Hey everyone! In this video, we're going to go over some trader jargon, some terms that you might hear, maybe some of our videos, or when we're doing a webinar, or when we're trading, just so everyone is informed. It's kind of a lingo that we're used to, but maybe you've heard some of the words and you're like, what does that mean? So let's get into, Jeff, you want to start us off?
Yeah, like the word shit. Shit. No, just kidding. I mean, there are terms that we talk about, like we say the market's bid,
I was actually just thinking that.
right?
The market's bid up. What does that mean?
The market's bid up means that the bids are driving the market. The people buying, the buyers are controlling the market. Bids are going higher, bids are pushing. The market's offered, the market's being sold, the market's being distributed. That's when people are selling. That's when there's money dumping stocks. So when we talk about bid, when we talk about offered is for sale, bid is to buy. When the buyers are in control, it's bid, market's going higher.
Another term you often hear, like, oh, this is a breakout trade, or the stock has momentum. Basically, it just means the stock is either cleared prior resistance. It could be on a 1 minute chart to a daily chart, or momentum is the stock is pushing, or pushing is another way of saying moving higher out there. So the stock has momentum.
Yeah.
Intraday, it might mean the stock's moving higher on volume, or let's say it's like a stock like Netflix. They had earnings moved higher and then had a big move yesterday. Now that stock is a momentum play because it's had a big gap up and it's continuing going. We also call that gap and go.
Yeah.
Day two is very bullish when you have the market bid or a stock bid,
Yeah.
and then it goes up again. It's very, very, very strong right there. I think you often hear me talk about flow or paper, and that's just basically option contracts coming in. So if I'm like, hey, Apple's seeing big flow today, or big call flow, really flow, mostly bullish because I rarely ever do puts. But if I say, hey, there's a lot of flow in Apple weekly calls today, it means there's a lot of option buying in those Apple weekly calls. Or paper. Paper is referring to the options market or options trading that day. So you often hear those terms as well. What else? What about some breakdowns, liquidation breaks, squeeze? How about that? Squeeze.
Short squeezes. So, big popular term that people were talking about a lot last year. And it's going to come back into play because there's going to be shorts that are still out there that are caught.
Yeah.
Basically, when a stock is oversold and it's overshorted, it sets up a situation where stock can move viciously higher in a really short period of time because shorts are squeezed into covering. They have unlimited loss potential on the short size. So squeezes can be particularly violent in their movement higher, much stronger than a lot of momentum parabolic moves, in the sense that panic that shorts create from a squeeze is unique, like I said, because they have unlimited losses that are occurring, especially with leverage.
And you often hear we talk about short squeezes. A lot of these stocks are, I call it like a shit stock, a junk stock.
Yeah.
Usually these stocks are highly shorted, meaning a lot of big money players are short the stock. It might be a stock like AMC, Bed Bath & Beyond, Lucid Motors, Neo, Tesla, that they don't have the best fundamentals, right? Or they don't have the best chart. But when they go up, those shorts have to cover. I mean, they have to buy.
Yeah.
And which drives price higher. Or a term we often say is don't short in the hole.
Don't short in the holes when the stock's down a lot and you're already starting out in a situation where as soon as you put the short on, it's starting to go against you. So you're already in the hole. Why it's called the hole is it's down a lot. You're shorting it in a momentum down move, and it starts working against you almost automatically.
And a lot of times, too, implied volatility is high when you're shorting it in the hole because the stock's been down a lot. When stocks go down, implied volatility goes up.
Yeah.
And then when the stock starts going up, implied volatility, we call it implied vol crush. That's usually after an earnings event or after like an FDA approval, meaning volatility ahead of like an earnings or a bankruptcy or FDA approval. There's a lot of unknown factors.
Right.
And then after, let's say the earnings or the approval, the FDA approval or whatever, volatility comes down, so therefore the price of options come down. We call that a vol crush or implied vol crush, or a lot of platforms refer to it as IV right there.
Another term I use a lot, and because it's the style that I use a lot, is fade.
Fade.
I say I'm fading that move. What does that mean? It means that a big move happened, like a squeeze move, and rather than buy the squeeze at the end, you squeeze stops going up, I think it's going to fade down. It's like the sun got really strong and the sun starts to fade. So when I say I'm fading a trade, I'm going against the market. Stock's up a lot, I'm shorting it. Stock's down too much, but it stops going down, it's going to fade back up. So when I say fade, I mean like the power of the move is done. I expect a reversal, and I'm going against the market.
That's good. And then it also brings me, and I'll say this a lot, trim and trail. So trimming is something like, let's say you buy 100 shares of stock and the stock goes from $1 to $1.10.
Yeah.
Trimming would be maybe selling 50 shares or sell half the position and keeping the other half on and trailing it as the stock moves higher, keep riding it higher. And if it comes down, then you would exit the balance of your position. Or let's say I buy like 10 options contracts at, let's say, $1 and they go to $1.50. I'll trim some of the position. So maybe I sell 5 contracts at $1.50 and keep the balance on, or let it ride to see if the stock moves higher and the options continue to move higher. Then I still have exposure, but I take some risk off by trimming some of the position.
Well, another way to say that is I say I leg into a position.
Yeah.
I leg in. If I have to buy 10 contracts, I'm not buying 10 at this one price. I didn't find the magic price to buy it. But if I want to do it in like the last 15 minutes, I'll do 2 and then 2 and then 2 and then 2. And then I'll find myself a nice blend of an average price, but I legged into it in the same way I'm legging out. Well, Lance described with the trim and trail, with the trailing stop, is you're locking in money. You're making yourself whole. You're protecting your capital, but you're allowing that upside to keep going. So stocks will always surprise you in how much they can continue to move. Every time you think that you got the high, it's going to surprise you.
Yeah.
So allow yourself to get massive wins by leaving a little bit on, legging out, trim and trail.
Still having exposure there, and also too will help you when you're like, oh man, I wish I still had this, or I wish I still had my position in stock XYZ. You'll be like, oh, I have maybe 2 contracts, and then I think from an emotional point of view, you'll definitely feel better out there. Stop loss or stop is just like, let's say you bought a stock at $1 and it goes, let's say, I don't know, 50 cents, hits your stop. It means you just get rid of the position, move on, sell it.
Kick it out.
Move on to the next one. When we say, a lot of times in the option market, when I'll say weeklies, that means the option expiring
that
Friday. So let's say today's Tuesday. Is when I say, hey, I bought the weekly Tesla calls, the option's expiring Friday. Not next week or not the week after, but when I say weeklies, this week. And we say monthly, the third week of the month. And usually, I know for myself, if I say, hey, I bought the Feb calls or I bought the March calls, I'm always referring to usually the monthly.
Right. Yeah, if you name the month, it's the month.
Yeah. If I say like I bought the March 25th, 2023 calls, then that would be the last week of March. Stuff like that. But you're pretty
weekly
rare.
Is good. So weekly or the name of the month. It's very simple.
Yeah.
Like if you're going to say weekly, it's got to be this Friday. You don't even have to say what the date is. Just say this weekly.
Right.
But there's so many, like when we think about it, like we could probably talk for like 45 minutes on this stuff. But I think it's a good little primer that we have so far.
Yeah, it's about eight minutes or so, and there's probably other stuff we left out.
We'll do more stuff like this.
Hopefully, some of the terms you've heard, or maybe
I'll say like clean up your book. The book is your portfolio.
That's a good one.
Because like the floor brokers used to call it a book. They literally used to walk around with a little book. I've got these trades in my book. These are my longs. These are my shorts.
Right.
So trader parlance, clean your book out means go flat, get rid of all your stuff, go to cash.
Or when we say hedge, when we say hedge, it's not, you buy the VIX or something like that. It could be, let's say you have 5 longs and you need some shorts too. So hedge some of your risk, in case you get to move to the downside. When we say, or let's say you're all short, maybe you buy some calls to hedge your shorts.
Yeah.
Hedge when we talk about stuff like that, like clean your book, use proper risk management, it basically just don't have too much exposure, so if a move can go wrong, your whole book or your portfolio is blown out.
Blown up.
And I think
we'll leave with blown up.
Yeah,
don't do that.
No
blow ups.